Good morning, everyone. Good afternoon and good evening. How's everybody going today? I hope you're having a great day, guys, and I hope you're ready for the market. Now, what do we say on this channel about slightly bad news? We've just seen the unemployment numbers come out. Of course, here, 360,000, slightly up on the 350 expectation, and the market's slightly rebounded there. Let's have a quick look now straight away at the markets. We have a 0.06. Oh, well, they've come back down. they were slightly up. It was like a 0.26 down on the S&P. But yeah, slightly bad news. Basically a hit. That's pretty much in line with the kind of things that we want to see here in the market. How's everyone going, though, through the session? I see you, Oliver. Good to have you here. Dr. Horton, Kevin, Bloodbath McGrath, Sakura Chan, Say What, Rashad, Mitch, and many others. Trilly Messiah, Bradley Back, and all. So I'm looking at this chart, and I'm thinking, damn, that's some nasty looking futures candles. The fake market futures look pretty bad, don't they? I mean, you've got a rejection wick, and then a potential rejection wick today. Now, we don't have the daily close, but I tell you what, if I was a day trader and I was looking at this, I'd be like, should I be worried a little bit about a potential pullback here on the Nasdaq, at least down to the 20 exponential moving average? Let's talk about how long it's been since that's happened. A long time, guys. A long time. Generally, we've been following it with the 4-hour 50 exponential. We're going to open up right around the 20. So there's nothing to be concerned about yet. If you're an ultra bull and you like to get involved in bull action, 15,000. A movement above here should create quite a lot of bullish algorithms. 15,000, guys. Look at that. 1 hit, 2 hits, 3 hits, resistance every time, and then a massive sell-off after that point. Short squeeze it, Tom, says Trishan. I think the market is definitely warranting, you know, some action with options to the negative side. You want to just start taking a little nibble, I think. You've got to be very, very careful about the way you do it, but when you're approaching peaks, sometimes you can pull the trigger if you know what you're doing. Sometimes, but you need to obviously give it time. For people out there that trade 2 or 3 days or weekly options, you guys are mad. That's not giving it enough time. Welcome to the 700 viewers already joined us this morning. Thanks for the thumbs up, guys. Appreciate it. Thanks for the support in yesterday's video talking about stop hunts. Hopefully you guys enjoyed that one. We'll be creating more content. I should have a trading view like basic guide as well, how I like to set it up, what I like to do. If you guys support that, subscribe to the channel and click the buttons all over it, that would be much appreciated. I should have that out either this weekend or early next week. All right, so US 100, we've got the 20 exponential finding support here early. We haven't had a new bounce buy, so as in like we haven't seen it break through. So do I like the 20? Not so much. I don't like the 20 as much as I like it when it goes down, makes a new peak, comes down again, makes a new peak, comes down again. That's okay. That's a healthy, normal market. But when it goes and hits 2 resistances, I don't like it as much. I'm looking for a 15,000 closure breakout to create quite a lot of algorithmic trades. I think 15 to 15.1 seems very probable. What do you guys think? And of course, I still like the idea of a 50 exponential moving average being 14.8 finding support. So we're about 100 points off that. So whether it goes up 100 points, then breaches, and then long, or whether it goes down here and some dip buyers start to look around this level, be warned, there is wicks that can occur here. I think we're still in a good place from the US 100. But a lot of people have been bringing up the same point, and I want to talk to you guys about it. This stock here, Apple. We've been very bullish on it, of course, after the breakout of this occurred. We're talking about some pretty serious numbers. This, to me, smells of buy the rumor, sell the fact. When we have Apple doing its announcement, obviously reporting its earnings, I would not be surprised at all if the stock runs and continues to run into that event and then sells off either a day before or even on the earnings day. I don't think, and I've said this quite a few times, that we're in a market that is going to meet the expectations of the optimism currently out there. KZ No Limit says, happy lockdown, whole of Oz. Yes, I didn't even know. Someone told me, I was like, no, please. Please, no more lockdowns. Yeah, we're back in lockdown, guys. It sucks. I got to say, nothing cool about lockdowns in Australia, and unfortunately, that is exactly where we're at. We've got Bradley back coming in with a $5 donation. Saw the video from last night about small rotation into consumer defense. VDC looks like a solid play if it continues. We'll take a look at that in a second, Bradley. Thank you very much. So, things that happened today. Notables. Shanghai Composite came in very strong. You can see that it went back up to the resistance. Let's have a quick look at the Barbers. How's the Barber looking pre-market? Very tasty. With the Baidu up as well. We've got the JD flat. So the Barber is moving strong early here in the market. If we have a look at daily close, you'll notice it didn't quite give us the goods yesterday with a nice closure above the 213, but hopefully it will do it today. Good signs here out of the Chinese tech stocks. A lot of people have been asking me questions about what my expectation is. Do I expect Chinese tech stocks to recover to 317? No, is my answer. I do expect them to go to like a 240, maybe even a 260 level, but this is a lot to ask considering this deglobalization that we're seeing right now. And I think that's a trend that's going to continue and continue. And we're not going to get political or something, but when you have a government intervening in any market, it always takes away a lot of investors. And I think there is a recovery here, a trade here, and I'm not convinced necessarily of the longer term play. Even though I think the company's good and all these companies are very, very good there, I think this deglobalization concept is something that I'm looking very strongly at when you talk about medium to long term. And I'm talking about 2, 3, 5 years. That's the type of thing that I've got a problem with. That really is the major concern I've got for those companies. US 500, at this stage, everything looks fine. Nothing to be concerned about just yet. Any touches back down to the 20 moving average hopefully should be met by buy demand. You can see it's made a new peak after hitting down here. So again, it's in the uptrend at this stage. And we continue to stay pretty much the course, which is we're cautiously optimistic. We're not adding too many positions from a technical standpoint, and we're using our community trend line to hope and pray that this level here is reached sometime in the earnings season. Let me just change the color of this for you guys. Make that yellow. There we go. Jimmy Bieri says, now is the time to buy Barber because no one wants it. That's correct. No one likes it right now. Darth Sidious says, short Barber, go long on the 40 Thieves. Okay. Please, Tom, do CLF. We'll see if we can get round to it, man. I'm not sure if we can. Nothing like watching the Open with Tom in the AM, says Scott Morgan. Hello, Scott. Good to have you here. Good morning, Tom. Will we have a look at Amazon today? We certainly will. And then Warren Chairhart says, Apple earnings 27th of the 7th. Exactly. Ominous. The end of July. Well known the end of July to be a little bit shaky. July generally good. The end of July, that last week, usually where the flick of the switch happens, and it's often gone negative. Let's actually have a quick study here of the US 500 before we do Bradley's donation and others. When was the July? It was a few years ago, if I remember rightly, that we actually had a sell-off in July. Let me just check here. Let's go to the SPX. June, July. This was a nothing market. And then straight after that 27th, 3rd of August, it dumped itself into August. And then, of course, rallied and then dumped again. Now, a lot of you wouldn't have been trading this market, but I do remember that end dump of July, because I usually look for the September kind of October weakness in the US market. And yeah, I remember this one. So it was actually sideways for quite some time. Obviously, then got very bearish all of a sudden, double bottomed, went back up to the peak, and then gave a second nasty pickup. Look at this one. You know, for people that haven't been trading for a while, this is a very nasty new low that's formed here. But then, of course, you see these two big bullish candles. I mean, it doesn't get better than that to buy. When you're looking at a weekly and you have bullish candles like this, you've got to have the right stops, because initially you would see this and you'd think, damn, I want to buy it. what do we talk about a lot? Actually, almost is a lesson here. We always talk about follow through. We like to see follow through by a percentage. Guess what you don't get here? There's no follow through in the next week. See over here, follow through. Over here, follow through. Now, admittedly, it did go back down again, but you've still got to have your correct stop underneath the lows. So I like to wait for the follow through. It would have saved you the pain over here. It would have got you in on this position. It would have got you in on this position. It would have got you in on this position, and obviously here you would have also gotten in, but you would have been safe with the correct stop, as you would have been over in these ones. I always think less pain is a better result for me. So at this stage, the market is looking okay. We've got still quite a lot of strength. We're obviously down here in the morning with the US 500 down, but the Nasdaq slightly up with the unemployment figure coming in basically on a hit or a slight miss. That is not a bad sign. Bad news, slightly bad news, or hit news is fine with us when we're talking about the Fed. We also saw Papa Jerome start talking about cryptocurrencies yesterday, and that's led to further declines in the market. You know, I think this will really expose something like Tether. It will really expose Tether. Tether's going to be the question that a lot of people ask. I haven't kept up with the crypto news over the last couple of hours, but if there's something, let me know, chat. Otherwise, we had a bullish hammer, and this is a great example of no follow through. We're now at the lows. It's time for Bitcoin to turn around. It needs to turn around right now, pretty much. And I want to see some bullishness come back into this stock, because if it doesn't happen, into this crypto, because if it doesn't happen here, I mean, this is not good at all. This is a series of lower peaks. There's all the type of stuff that I tell you about when I don't like markets. That is very uncool. Very uncool. Sad face. It's unfortunately sad face. Bradley back. VDC. Let's have a look for you. Vanguard Consumer Staples. Ah, very nice. Yes, you are correct, Bradley. Looks like a solid play if it continues. Yeah, that's correct. So you've analyzed this, and you've done a pretty good job of finding decentness. Now, a lot of people would say, I can kind of see here maybe, some kind of head and shoulders pattern. Let's go back over the daily. That is a hideous looking chart. We're at the resistance, but you guys know I love seeing a shooting star pin bar rejection being taken out with a big bullish candle. This to me shows rotation going into consumer staples in advance of rotation coming out of the stock market. What have we got? Let's think about the timings. What time did this start? 18th of June. I want to put next to this TLT, which is the 20-year bond. Okay. Let's have a look at the daily. All right, when did these bonds start really recouping? So they came off their March lows, May, then in June, they started really picking through. So we've got rotation into VDC at the same time as TLT is going strong. And then utilities, let's have a look at the Vanguard Utilities ETF. Started going later in the month with some bullishness. Yeah, whenever you look, this is a good pattern as well. You want to talk about where there's good patterns from a technical standpoint. Utilities double bottomed, coiling at the peak here, and is looking for an explosion out. So utilities is looking strong. You've got consumer staples ETF looking strong as well. These both signal to me you've got two really strong defensive sectors traditionally that are actually down on where they've been back in, over here, back in the start of June for consumer staples, and of course for utilities quite a while ago. Interesting stuff. Do I like these sectors? Not really. However, they are both breaking out, and you are correct, Bradley, that is a decent pattern strength coming through for that one. Looks better than the banks, let's just say that. Amgar Pradeep super chatted $5. Great content. Thank you very much. Would love to see your trading view videos. Yeah, we'll be doing those soon. So stay tuned, man, and appreciate your support. Thank you very much. Got Chris Kennedy coming in with $4.99. Hi, Tom. I have an odd one. Can you have a look at the CBA? Thank you. Yeah, we'll check that out in a second. Let's see what the community's saying as well. TLT is bouncing hard. Bad news for stocks. Yes, generally speaking, if the TLT is bouncing and finding bulls, if you're seeing a move on a rotation into the 20-year bonds and it's part of a bigger kind of pattern, it means money is usually coming out of stocks and going into bonds. And it's that slow, gradual rotation. Remember, Wyckoff theory, which a lot of people have become familiar with over the last couple of years, the whole concept of that is effectively that we have a maximum extraction of money from the market. And that's what Wall Street's idea is. They want to get every single person hyped and into the market. They start rotating out, creating kind of like flash dips that are purchased by retailers as they sell off, flash dips. Like the other day, it's always a good sign as well when you start getting flash dips near the high, followed by big rallies. And then they basically dump the final position and load those puts in. So they want to get maximum extraction and they do it that way. Let's have a quick look here at the weekly. So very large rally here since 2020. You're at 1996. Let's take a look at the horizontal line for you here. Okay, so pretty nice move, 1835. You got a massive breach out. The question is, has it moved too quickly for you and should you be waiting? This would be one of the ones that for me, I'd wait for it to pull back down to this level and then pick it up unless I was in it. Yeah, it gapped above. Yeah, yesterday and held. I'd wait for it to pull back. I don't like a gap. I usually find gaps do fill a high statistic of the time, especially a gap like this. Great bullish sign. I don't know why. Earnings, I guess. Who knows? And the next level for it's $22. So if you like CBA, sure. It's consolidated at the peak, had a nice move up, gapped higher. I think it's due for a pullback. Thank you very much, Chris. And then we've got a Noop Sonpar super chatting $5 Singapore. No message, but thank you very much for the support. Thank you. And Chris says, Tom, could you please have a look at Tesla? I'm very optimistic going into earnings. Do you think a test of 700 is still possible? Thank you. Yeah, yeah. Yesterday we left Tesla on the bull train, is what we hoped. And what a nasty long leg doji decision make. I would have really liked it to hold here, man. I really would have. Look, it's not a statistical likelihood right now. When you look at a chart sometimes and you go, oh, you know, what can I make a prediction for the next level? Sometimes you'll be at zones that you believe you have a statistical advantage of, and sometimes you'll be coin flipping. And today, realistically, it's more of a coin flip day on Tesla. Now, you might be seeing something I don't. Somebody out there might say, oh, Tom, I see something really great on the Tesla chart. I think it's going to bounce straight off this zone. And it absolutely could. I mean, you might say, oh, it's near the daily 20 or something, and you like that. It's at a 50% fib pullback. Maybe you like that. I would say coin flip today. I'm optimistic that a lot of stocks will run into the earnings. So even though we're down here in the morning, I still think that this is a buy the rumor, sell the fact kind of event. Hopefully it does play out. That's more of a gut instinct than anything else based on the TLT, based on the trend lines and everything else that we're seeing rotate into consumer staples, utilities, etc. So I would like to think that this is just filling that little gap over here, and we're ready now to make a movement on. Now, I've talked a lot about the 700 zone being a key critical level. And for me, actually, any daily close above 691, I actually think is an early indication to start scaling into an order from a technical perspective. Because at 700 or at 692, what have you done? You've basically closed at a point higher than anything else. So you can see it's up in the pre-market here, 0.55%. The rest of the market is kind of down a little bit. Hyper stocks got pretty bashed yesterday in quite a few of them. So I'd expect quite a few of these hyper stocks, which are at support, like Enphase. Look at Enphase. It's directly back on support again. Got absolutely destroyed, straight back into support. This is the type of day where you're going to see other hyper stocks all sitting at supports. What else do we maybe have at support here? Do we have Neo straight at support? We have Neo straight at support. We have, what else? AMD, did that go down? No, that's not quite at support. Do we have anything else? Just looking at all these ones that went down yesterday. T-Doc. Oh, that looks disgusting. T-Doc looks horrible, unfortunately. What else do we have here? What about this one? TTD. TTD, previous buy level. So all of these hyper stocks, mostly across the board, are at straight on support levels. And that means that there should be slight bounces across the board on them unless they really are going bearish. I mean, somebody said, I'm going to put puts on the hyper stocks yesterday to me. And I said, oh, yeah. Do you think do you want to do it right now, or are you going to do it a little bit later? I wouldn't do it just yet, but I can see their points. You know, big returns. We've got to put this in perspective. That's a return of 71% on TTD here. 71%. It's barely pulled back so far, and we're coming down to a 20 and a 200. This is one of my favorite kind of zones, really. I like these zones to buy because when you think about it, if you take a fib of the whole move, it's probably just like a 23.6 around here. And if you take a fib from the last kind of low, I guess we'll use this one, then you're going to get a 38.2 in that area. So you got kind of like a lot of fib opportunities right around there as well. So TTD, you know, it looks bad on a chart, and I think that's not even arguable. It's not exactly ideal, but things can look very, very different. We've got a bearish candle, an indecision candle on the weekly, and we could very easily see this rebound in the next couple of days of trade. So the answer for the Tesla question is coin flip at this point, but a lot of hyper stocks are at support, so maybe that will also force Tesla through. Then we've got Yanni coming up with $5. Hello, Tom. What's your opinion on SOS and TAOP? Thank you. We'll take a look at that very, very soon. Christopher Collins says DocuSign puts. Well, I hate DocuSign. Let's have a look at DocuSign for you, Christopher Collins. Oh, well, I think that's a bit more fair. Again, you are on a supportish zone, previous resistance. Tell you what, though, man, imagine if you got through. And DocuSign ran very hard, maybe too hard. Very hard, 66%. Another incredible return here. Maximum extraction. Big shooting star comes off here. Back on the support. 20 moving average. This is the time that you hope it bounces. And if it doesn't, well, you know, you're breaking through. And then where's the next stop? 240. Pretty incredible stuff. All right, let's do SOS. Haven't looked at this stock in a while. And it's been degrading quite hard. That is a no-touch zone. SOS is terrible, to say the least. Can we get the knives in the chat? I need to see knives in the chat, guys. That is a very unfortunate stock. You would be catching an absolute falling knife at this stage. It came back up and flicked around this $4 mark. Previous kind of supports and resistances acted as again. You got a 20-50 cross on the weekly down. You've got no real support until $2. So unfortunately, and that's just a psychological level, nothing more than that, and the middle of that kind of range. So that is a falling knife with really low volume. I do not like this chart. If you're wondering how you find maybe a recovery in this, you've got an incredibly steep decline here. So usually what you would do is you'd take like a trend line on the decline and look for it to break past that. I guess in this case, it would probably be the 20 moving average getting breached above, but you'd need maybe even more because look, 50 happened here before and didn't do it. So the first sign of recovery is getting above the 20. The second sign of recovery is creating structural base. And what you should always look for is this type of thing for a while. Go take a look at the gold chart and you will see that. And speaking of gold, we'll go check that out very, very soon. Yes, Richard, we'll see if we can do CLF. TAOP. Taoping. Another incredible decline stock. That is unfortunate. Another falling knife. I really don't like it, man. I wouldn't even, again, I would never touch these stocks until you get formation base. You can't. Otherwise, you buy in here and you get slaughtered all the way down to here and you end up looking, you know, at your portfolio every day being sad while other people are celebrating Apple. I mean, that's the unfortunate truth of catching one of these falling knives. You have to wait for structural base. 9 times out of 10, my made up statistic, you will see this type of, you'll see some kind of structural base. The only time you won't will be usually a big tech stock that's all of the market's falling, or a Twitter or something where they've got this chance of recovery pretty hard, because that is horrible. I really don't even know where it's going. How low does it go? I would think at least $3.20. All right, let's do the CLF for Richard. Let's have a look. Cleveland Cliffs. Haven't looked at that one in a little while. It's continuing its... Is it continuing its range? Okay, so nothing's changed from our last time analysis. This is what we had on it last time. 2166. So it is not quite at the bottom of our range. However, you don't really want to be touching the bottom of a range like this. You did make a new high. 50 exponential's been okay recently as well on the daily. I'd like to see a turnaround here. But, you need this thing to start, putting a bit of work in. This is not ideal. It only usually went up twice, came back, and then went to the new high. That was a beautiful lightning bolt. This is very slow. Very slow. Kind of weakening. So, yeah, watch it around here, Richard. Watch it around there. Oliver Quinn says, Tom, Lulu, why are the calls so beeping expensive? Well, part of that is going to be the massive amount of movement recently. So remember, with implied volatility and with buying options and stuff like that, and this is why you've got to use spreads and you've got to use different opportunities to trade. When you look at this chart and you put it in perspective, most of the options are probably going to be priced for you based on the last couple of weeks of implied volatility. This stock has been going up incredibly quickly, man. Incredibly quickly. So if we go and scroll through here, you've got a 27% increase. You're going to have a massive cost on the option. That's why a lot of, professional traders, they'll sell the premium using spreads, using different types of, effective positions. And then they'll put in, using that premium, other trades. It might be butterfly spreads. I don't know what they, iron condors, etc. A lot of people sell premium for a living with risk adjustment because options are so damn expensive sometimes. This is a long leg doji at the peak. I wouldn't touch it. But for a call perspective, you're at the resistance already. Long leg doji on the weekly for Lulu. Not worth it, man. John S, $20 US. Let's give him a clap, man. That's awesome. Thank you very much, John S. I think John S is a bond player. Let's have a look here. I know bonds are boring to most people, but can you explain to the community how hedge funds participate in the repo operation to borrow 10-year bonds and then sell them short to gain liquidity, and what happens when bonds start to rally? I probably won't be able to explain fully that portion of it. I mean, my bond knowledge is basically I look at bonds from... I buy certain bonds in Australia, which you wouldn't know about, which are called hybrids. I specifically love those types of bonds. My knowledge of the markets to do with bonds is basically the way they're linked to the market. And I don't go into so much hedge funds participating in the repo operation to borrow on 10 years and then sell them to short gain liquidity. It's not really something I look at, John, but maybe your knowledge is even better than me there. What I use it for more is if I see bonds going into a cyclical, what I call a cyclical bull cycle. So if we go back through a bond study here, you'll notice that for very short periods of time, bonds rally. So they might rally here and then they become horrible investments for years. Then they become even more horrible investments and then they go on a massive rally. Now, if you're spotting a rally that's got to do with your, let's say, technical analysis as well, I will use the bonds in that scenario. I also will buy bonds when I see very nice technical analysis. Like say here, for a long time, I would probably have bought bonds here. So I would have bought bonds through this breakout and I would have taken them in and I would have sold them right here. And once that had happened, I'd be done with the bond market. I just wouldn't even bother looking at them again because you basically bought a very solid structural base after a huge fall off. You've taken it into the level and you haven't seen enough information for getting you into further positions. There's an inverse head and shoulders. You know, it's a very nice one. You've got left, you've got the head, you've got the right shoulder, you've got a great neckline. And that calls for a break above this resistance, which leads to a massive gain. I would buy bonds late cycle because when you see this type of thing and they've been horrible for years, and then you think about, oh, I'm in 2018, 19, we've been going on a bull run here for 10 years. I know that cycles go like an 8 to 10 year kind of time frame. If that's the way I'm looking at it, I'm going to buy bonds through that time. In terms of the way that 10 years and bonds are interlinked, my general opinion is that I look for them to fire. If bonds are firing and I'm seeing bearish signs on the market, I go for the market. And I will take the bonds if I believe there is a better return in the bonds than there is in the market. And sometimes there is. I made the argument over here that I thought bonds would beat the market for the next couple of months. I tend to think that still. Bonds will beat the market, in my opinion, but you better be warned, John. If I saw the bonds go back up to 155, 154 up here, just like on that left-hand side, I'm not touching them for quite some time. Here. Yes, that would be what I'd do. Thank you for the very generous super chat though, man. Yes. It's good stuff. Bloodbath McGrath says, lol, he does look like he joined the church. Yeah, I've got the turtleneck on today, guys. I got the old man turtleneck on. It's all good. It's cold, man. It's cold here in Melbourne. It's not a warm place. All right. So we're going up to the 154 as far as I'm concerned here on the bonds. And I'm looking at the daily 200 breach out to show me that we've really got something to be concerned about in the market. As long as it keeps going up like this 20, I'm following that thing. All right. QCOM is getting a request here from Mary Marsh. $4.99. Says QCOM, please. I'll do cold steels in just a second. Let's have a look at QCOM. So QCOM had an incredible, great rally at the beginning of yesterday. I was very happy for you guys. I was like, yeah, finally. And then just like the rest of the market, it came down. Look, I'm still bullish QCOM. You guys know I like the semiconductor market at this stage, just from the trade perspective more than anything else. And I don't like this candle. You know, it sucks. But we have to put it in perspective of, even though these look like bearish kind of signals, at the same time, we got above the resistance. As long as the market can hold up a little bit today, which it's kind of, you know, flatlining, we should be able to hold above this level. So I'm still bullish on it to the exact same levels. It bounced kind of off that resistance, which is not ideal. I ignore this candle because of the way it formed. So for me, it's just we're above the peak, and I'm hoping that we can continue to go bullish over the next couple of weeks. Whether it happens today or it happens on Friday, I'm feeling okay. Cold steel, $10. Good morning, Tom. Can you take a look at Fizz and TTCF? Certainly can. By the way, John, I hope that you do very well with your TLTs, man. That would be sweet. And the bond market also, I will let everyone know, is not a market. If you are just new to stocks, if you're a beginner, if you're even with 1 year worth of knowledge or 2 years worth of knowledge, you probably will just look, but don't touch. Okay? Look, but don't touch is what I would say about the bond market. It's not as easy as people think. It's good to look at and to know that on a very basic nature, what you might be doing. Fizz looks really short. Big breach could happen today. This looks terrible. I don't know what happened over here. This must be one of those stocks that went in the crazy run. It's incredibly bearish from a series of lower peaks being formed. And this is really down to it. I mean, it's going to crunch itself here and probably fall away to like 39. Yeah. Nasty looking candles. Let's have a look at the 4 hour. Nasty as well. You can see even here, very steep decline. That looks, I would be way more bearish than bullish. I mean, it gets above here, maybe it's going bullish, but yeah, at this stage, that looks absolutely terrible. Let's have a look at TTCF. Hopefully that's what you're looking for. That's the tattooed chef. I remember you bought this up a while ago. have a look at the daily. Go to the weekly. The Tattooed Chef. Well, they sell like food or something. Is this like food delivery? Ugh. It looks like a SPAC. Is this a SPAC? Dodgy. SPACs are dodgy. All right. So what's going on here? Ugh. Bro, this is very, very, very tough chart. I would say it's already being shorted. So you've got like a peak, a trough, a lower peak. I wouldn't call that a lower trough because it gapped down and then bulled straight away. So you might get a lower trough in today's session if it doesn't bounce right here. So see how that gapped down and then bulled? You can't call that a lower trough in my perspective from a closure standpoint. Oh, it's so close to going bearish again. Yeah, I don't like that chart. I wouldn't really touch it. Kathy Stinchcombe, thank you very much for being a member for 2 months. Appreciate you, Kathy. Thank you very much for that. And iTech, AY Tech, super chat at $5. Please take a look at Nvidia for me. And thank you. Will do, man. Will do. Can you do Roblox? Yeah, I can do Roblox. This is for Sunny Official. That looks pretty bad. Another IPO style business. What I have a rule, guys, and that is don't touch IPOs in the US market unless you're in the pre-IPO or you trade it on the first couple of days. Just don't do it to yourself. Don't put yourself through the 12 months of pain train. My rule, I come back in 12 months and then I look to pick it up if I like the company. Very few. In fact, does anyone have one? Has anyone got a tech IPO that's come in the last couple of years and actually done well out of the gates? I'm not talking about DraftKings. I want other things. How many tech IPOs have done incredibly well? I would say it's worse than a coin flip. Worse than a coin flip, I'm pretty sure. This is right on support. However, you are kind of catching a big sell-off. You have a long leg doji, decision made, kind of bearishness here. You can see it. And then you're back on the support line, again. So do I buy that? No. Do I look for recovery? Yeah. I'd look for lightning bolt, smaller time frame, structural formation base, movement up. That's the type of thing that we look for here in these types of markets. By the way, we're about 21 minutes away from the market open. Thank you very much for the 1,300 viewers joining us. We had the unemployment figure came out. It was pretty much just a slight miss, which I think is a relatively positive thing for the market. The market doesn't want really strong economy. It wants kind of like a medium economy at this stage. So we can keep Papa Powell's money. You got Papa Powell also coming out. I believe he's testifying. Let me just check here. 9:30 a.m. So you'll be testifying in 20 minutes. This is 9:30 a.m. Eastern time, so New York time. He'll be testifying and saying whatever he feels like. And then tomorrow, remember, join us at 8:30 a.m. ET for core retail sales and retail sales. I never get excited about core retail sales and retail sales. I don't care. But when you've got the threat of stimulus being taken away, all of these numbers matter. And you guys know I usually don't care. From the start of this channel, in many ways, until this point in the last couple of months, I have not cared about this number. But now we do, and we have to pay attention to it. So that'll be an interesting one through the session there. Roblox, you got to wait for more information. Boytoninus Maximus, super chat $5. Well, that's an interesting name. Nothing old man about that top, Tom. Think milk tray man vibes. Okay, man. Isn't like milk tray man? Is that like what the dude that delivered to your house back in the day with the glass bottles that we're talking about? Can you have a look at CMP Compass Minerals, please? I remember hearing all these old school stuff my grandparents used to say, like where they used to wrap everything in butcher's paper and the milk and getting delivered to your house. Oh, craziness. It was like Uber Eats before Uber Eats existed. Compass Minerals. Let's take a look. Big jump, wasn't it? 13.18%. Hit the resistance and sold off. If I was in this stock, I would have sold right here, bro. Yeah. I'd be so happy too. Great buy, man, if you got it. Nice base structure. That's what you want for Roblox, by the way. That's the type of thing. You're looking for a really nice structure with a breakout like happened here. And then, of course, if you get lucky, you get lucky. It's kind of like Splunk the other day. For me, this will probably continue a little bit of decline. I feel like, unless it was some amazing announcement, yeah, I feel like once you move that kind of percentage on a stock that doesn't usually move that kind of percentage, remember, look at the left. When was the last time it had a gap up like that? Long time ago. Gap down. Maybe never. Oh, there's a gap. And that one rallied. When was that? Yeah. That was before the GFC. So you can't use that one. Minerals, everything was crazy. So chemical speciality, great result into the resistance. I feel like, could find some support just because of the support here, but yeah, I wouldn't mess with that one. I would not mess with that one. Too hard to call, unfortunately, Boytonis. Too hard to call. Solid Snake says the market is crashing in 20 years. Has anyone of you guys heard about the 18.6 year cycle? So it's like, I think it's like 18.6 years. It's like a property cycle concept. It's an interesting one. So there's like hundreds of years of study to do with 18.6 years. And basically that would be pointing to like a mega meltdown in the economy like 2027, I think. So will we have another roaring 20s? The 18.6 year cycle is like 2026 into 2027. So you might want to do, maybe I'll create a video about it one day. It's pretty good. It's pretty good on the property cycle. And we know a lot of the bubble. You want to talk about bubbles in the stock market. Go have a look at the property market. My God. The bond market. You want to talk about bubbles. The bubbles in the bond market and the property market, guys. Even more than the stock market. James B, $4.99. Why is trading futures harder than stocks? I know you refer to them as the fake market. They don't seem to follow regular TA signals. Well, firstly, they're open to illiquidity or low liquidity manipulation. They aren't open during the main volume times. So when you think about it, if you're trading the US 100 here, the futures contract, it trades all the time. So it's trading based on futures, based on the expectation of where Wall Street's going to open. They get it right a lot now, but they used to get it really wrong. On top of that, there's a lot of spikes that occur, which hunt it. There's, as I said, low liquidity times after New York close into maybe the Asian session. Sometimes there can be a little bit of funny business. But the main reason I don't like some people trading futures contracts, and I don't suggest it to a lot of people, is because a lot of people don't understand roles as well. And they don't understand the real cost. So like if you're trading wheat futures, or you're trading coffee, or you're trading orange juice, or lean hogs, or lumber, or whatever, people don't understand that when the roll time comes, you get messed up. It's like saying, "Oh, I'm going to buy the VIX, and I'm going to buy the VIX at 15. I'm going to buy the VIX at 10. I can't lose. I know it'll go to 20 eventually." Well, you might think you have a big brain, but wait until they roll you. And that's why when you can go and look at a VIX ETF fund, exchange traded fund in America, you will notice you get smashed owning the VIX for more than a couple of weeks. That's very expensive. So yeah, futures market, it's low liquidity, which is the problem. You don't get the true feeling of Wall Street. And I'm not saying you can't trade them, because you can totally trade them during the market open and close. Absolutely. Especially index ones. But yeah, some of the others with the roll and the contract expiries and stuff, remember, negative oil happened last year. That's not real. It's a symbol. It's something that happens only to futures contracts, which of course in that case was contango. Ivan NG super chat is $6.98 Singaporean. Thank you very much. Hi Tom, love Singapore by the way. Can you take a look at snow? I exited at 260 and I'm thinking of buying back in. I'm going to buy back in, he says. All right, let's have a look at snow. Don't mind the stock. Don't mind if I do. Yeah, man, it's sweet support. Yeah, it's good support, bro. Obviously, you're buying the falling knife of yesterday's fallback. But yeah, it's good support. We got that breach out. We saw the contracts come in. We've got resistance, resistance, resistance. 20 exponentials just underneath it on the daily. It's not bad. It's not bad from a technical perspective. Still got that longer term pattern concept in here. It's almost got its 1 year IPO anniversary, which allows it to be, it's in the zone now. It's 10 months on. Okay. It's looking a little bit better. So yeah, that is exactly, look, you're right. It's on support, but like anything, you're taking a statistical chance. If the market doesn't hold up, which I hope it does, and we'll look at Amazon in a minute as well for you guys, then that's fine. Stop loss kind of zones for a lot of people will be underneath here. So they'll be buying here and putting stops under here and here. Good luck, sir. Snow. Will it rain snow? I'm not sure. Can you look at gold, Tom? Actually, absolutely, Andrew. We'll do that in a second. Unpronounceable name person. Because I'm telling you, I cannot pronounce that name, so I'm not going to try. We'll call it HM. HM, you know who you are. I buy VIX every Thursday and sell every Friday. Well, at least you know that you've got to be in and out, hey? How's that going for you? Is that work? Buy every Thursday and sell every Friday. Wouldn't it be like buy every Wednesday and sell every Thursday? Isn't Thursday the more negative one? Permit Fisher says, you still digging Beam, Tom? I'm still digging all of the CRISPR style stocks. I love all CRISPR stocks. I know they're getting obliterated, but I'm not. Look, come on. Come on, guys. Who bought Beam up here? Come on now. No one buys Beam up there. That's bad. That's stupid. You don't want to be stupid. Biotech is known for pumpy dumpy. I don't have like a 1 month plan on these CRISPR stocks though. I got like a 10-year plan. That's right. Well, maybe not 10 years. My main problem with Beam has always been one thing. It's not their technology. I quite like it. It's the fact they got no running money. They got no money, guys. They need money. And unfortunately, that is the big problem with Beam. So yeah, I definitely think that all of these stocks are interesting prospects in the future. But again, be very careful in bio. For most people, it's going to be easier just to buy a bio fund. Sell VIX on the Friday works, says Will B. VIX Crush Friday is a real thing. Another Will says Friday is VIX Crush Day. Yeah, I mean, I don't trade the VIX, so that's pretty cool though. Now, what did I say I'd do before? I can't remember. Nvidia. 10 minutes away till the open. Oh, yeah. Wow. Wow. Do I hate this stock at these points? Oh my God, it's so close to going bearish. So you got like a peak, a trough, a lower peak, and you guys know that is a lightning bolt without a closure underneath. It's finding buy pressure today, and everything could change. It could bounce up and be glorious. But because look at this. 20th of July, the split occurs. What's the chat thing? What happens on the split, guys? I'm going to eat a chocolate bullet while you guys tell me what happens here. We've got 10 minutes away from the market. Thank you very much to the 1,320 viewers as well. Be looking at a few stocks for today as well, and gold in just a few seconds. All right, I'm going to eat this thing. That's good. What happened here before the split? Will it buy into the split, or is the deal done? What do you guys think? Michael H says new PT for Nvidia is $900. Nah, man. I don't reckon. I would be very surprised if Nvidia is able to continue to maintain. It's when everyone else is a big bullish panda that I go bearish. Come on. You really think so? Let me just read out the market capitalization, even at this price. $500 billion. Billion. This thing is up 55%. It's not a small cap. It's a big cap stock. And I'm not saying they don't have the best graphics card. They do. But yeah, I feel like the the buy the rumor, sell the fact is real on this stock. I hope it bounces for you here, but I'll be watching you, Nvidia. I'll be got laser eyes on you over time. Let's do gold. Gold rallied today to 1834 before selling off. Have a look at the 4-hour chart. Okay. Not good. Not a cool candle. So we got that beautiful rally I did the video on yesterday. Looks really, really good. 1834. Is that anything to be worried about? No. So it's just random. Go 2-hour. 2-hour 20 just hit. Like to see that probably be the bounce zone, but we do know the 50 has been the more better kind of area for it. I'd like to see it bounce here for gold. We'll see how that works. I mean, obviously, Fed Papa Powell coming out and talking soon. He can ruin everything. We do know we have more support down here. You can also see there's quite a lot of jerkiness in the gold chart right now. Breach above here should set up our 1840, 1843 zone. At the moment, on support. Ahead of Papa Powell. Ben Whaley says, I've been short Nvidia at 830. Good man. Good man. Post-split, Nvidia will be 650, says Big Dipper. I think you live up to the name there, Big Dipper. Yeah, I reckon. I really don't feel good about Nvidia. Every retail trader is bullish Nvidia right now. Everyone. And that chart was starting to look a bit sick. It was starting to look a little bit sick there. So let's talk about some stocks for today. So we've got randomly somehow up Square, even though Bitcoin's getting bashed through. Probably some PayPal thing or something. So Square still sick, unfortunately, after this Bitcoin gets destroyed. We got Tesla finding some support. Let's have a look at Amazon. Someone asked me about that before. Go the daily. Not really a great looking chart, but as long as the rest of the FANG are holding up, so should Amazon. It's not a great chart. I wouldn't trade that at all. But if you're in it, I wouldn't sell either. And if we have a look at the Webull market movements this morning, let's have a look at the speculation. Pre-market speculation. So we've got Ocugen, Beyond Meat. That's a failure. And then we've got Clove, GLPG, GameStop, 161. It was brutal on AMC yesterday as well. I saw that, unfortunately, that was down a lot. But can't say I didn't warn you guys that I hated it at that price and what the price action was doing. Could be even more to fall on it, unfortunately. And for the green things of the day, of course, we've got the Chinese stocks coming back into focus. That's definitely, things like the Baidu, the JDs, interesting. If you're looking at day trades, some of those things are, notable, I guess. And on the negative side, we've got a bunch of random companies most of you guys don't trade, and NXP Semiconductors. A couple of chips in there, actually. Apple opening up 0.22 up, rallying incredibly quick. The faster this goes, the more this goes into next week. Apple's announcement on the 27th, which is Tuesday, July 27th. Wow. So it's only really a week away now. Imagine if it rallies to 165. I'll get so bearish if that happens. So bearish. Dollar strength before the Papa Powell. Let's have a quick look here. We've got 5 minutes till the market opens. Yep, a little bit of dollar strength coming through. Let's have a look at the 2-hour. You can see the resistance up here at the 90-80. That'll be a key pivotal zone. We actually have higher lows coming through as well. So we'll see whether Papa Powell convinces the market that the dollar is great again. Things I'm looking at today, I think there's a lot of hyper stocks on support. Things like Enphase. Things like, what was the other one we had before that was really good? TTD. There was quite a few of them. I'm sure most of these hyper stocks. Snow. They're all right around the point where they have to find bullish control. Bitcoin new low. Yep. Unfortunate. Yeah, it looks really sick, doesn't it? Got to find ralliers. I'm still only looking at the weekly. I want the weekly close to tell us what's up. But GOG, I think the fact that the Fed's even talking about crypto, it just probably scares the whales. Let's have a quick look at how the whales are rallying in. Still adding to shorts. They are not declining at this point. We've got to watch that if you're trading it. Tom, can you look at TSM earnings last night? Let's have a look at TSM. So it's down here, 120.74. Well, that's not cool. Back on support. So obviously the earnings, I don't own this thing, but obviously the earnings were not that great. It's back on the 20, basically. Look, right onto support. All the semiconductors came down with it, I'm sure. But yeah, this is the point where if it's going to bounce, it's going to have to bounce right off that zone. Previous resistance is support. Makes sense. 3 minutes till the market opens. Let's watch a couple of stocks. We'll watch AMC just because, of course, that thing is really down and out at this stage. It's going to be pretty aggressive kind of first half an hour of trade, I'd expect. Let's have a look. Get that up. We'll look at the US 100. Some intraday traders might come in at the 14,920. That's pretty good resistance. So you've got like a series of higher lows so far. If that holds up in the fake market futures and you get a little closure above this, that might send some signals for buyers back up to the 15K. So we'll see what Papa Powell does to do that. Watch Tesla as well. 5 minute here. It is up 0.84% in the pre-market. And we've got VPU there, but we will watch M-Phase. I'm interested to see how this results. M-Phase on support. Very interesting. Crazy stock, this one. That's a crazy cat. That's a crazy cat, the old M-Phase. BTC going hard. BTC should bounce. It made a slight low, so it should find initial buyers. The question is, does it come back down and test it again? So we've got 2 minutes till Papa Powell comes out and talks. I'm not sure if I'm allowed to stream this guy doing anything. Let me have a look. Anyone got a link for Powell having a chat? Is it on the Fed? CNBC, they'll probably hit me. Actually, I don't think they did last time I streamed them. Bugger it, we'll watch it. If they hit me for monetary, if they hit me, they hit me. So we are up. We've got him 11:30. So we've got the Powell stream is ready to go. So we'll watch that together, see what's going on. If you want to check out some Powell. I'll just quickly change my thing. And 1 minute till the market opens. Here we go, guys. It's open up. All right, there we go. So Tesla opens at 658. The rest of the market opens relatively flat. So we basically do recover a little bit on the US 500. US 100 starts to move up here. And it looks like Powell is on the move. So we'll bring him over and we'll just chuck some information over the top. Where are you, Powell? I'm looking for you. All right, we'll check that out. Let's have a quick look at the markets while we wait for him to come through. Alibaba, 1.67, the ruler of today. Tesla, 0.94, good for you guys. Snowflake also recovering off that low. And it looks like a lot of hyper stocks finding initial buyers. And that's probably because they got absolutely obliterated yesterday. Heaps of supports, guys. Heaps of supports being found. Snow, Enphase, quite a few others. Negative side, Biogen, semiconductors after that TSM news. I might have to look at that. Twilio, SE, DocuSign. The put seller will be happy. And in the speculation list, so this is the hyper speculation, we got Clov. Wow, it's back to $8. I feel bad for people that bought that really high. And GameStop down 2.82%. Here he is, man. Wow. He's getting ready. Let's see what he has to say. I'm going to drink some water with him. I love it. You guys even hear it? tell me if you can hear that.
Senate Committee on Banking and Affairs will come to order. Today, our economy is growing because of the American Rescue Plan and the Biden-Harris administration's leadership. We're putting shots in arms and money in pockets. Families have a little bit extra to help pay.
Let me turn it up.
Day 15. Most parents will see a $250 or $300 monthly payment in their bank account for each child. In my state, 92% of children are eligible. Small businesses are reopening their doors. Workers are safely going back to work, often at higher wages. Last month, we added 850,000 jobs to the economy. Since President Biden took office, we've gained 3 million jobs more than in the first 5 months of any presidency in modern history. It's not only the jobs numbers, it's the quality of these jobs. For the first time in decades, workers are starting to gain some power in our economy, the power to negotiate higher wages, the power to get better working conditions, the power to have more control over their schedules and stronger benefits and more opportunities for career advancement. The Washington Post reported in the past 3 months, rank and file employees have seen some of the fastest wage growth since the early 1980s. Think about that. The fastest wage growth since Ronald Reagan said it was morning in America. That's what happens when we invest in our greatest asset, the American people. Instead of hoping money trickles down from large corporations, it never does, and pretty much every senator sitting on both sides of the aisle here knows that. We invested directly in our workers and our small businesses in our communities. When workers win, our economy wins. When everyone, as one of Senator Smith's predecessors used to say, when everyone does better, everyone does better.
Debt ceiling, guys?
Chair Powell, you said the Fed can help make the economy work for everyone by ensuring a strong and competitive labor market, one where everyone can get a job, one where employers actually compete for workers. I agree. Those efforts, combined with President Biden's recent actions to increase competitiveness, are increasing worker power in the economy. We must build on this progress with investment in infrastructure that creates millions of jobs, increases our economic competitiveness, spurs growth in communities of all sizes all over the country. I've been all over my state in the past few weeks, talking with local leaders, seeing mayors in both parties in big cities and small towns. I've heard the same thing from all of them. They need more investment in infrastructure, like housing and transit, to build a stronger local economy. These are the places often overlooked or, worse, preyed on by large corporations and Wall Street banks. Many of these communities have watched for decades as investment has dried up, as storefronts have emptied. Companies close down factories and move good-paying union jobs abroad. From Pennsylvania and Ohio, 2 states especially.
He's killing us.
Private equity firms, big investors buy up the houses and jack up the rent. Small businesses struggle to compete against big box chains.
Truly Messiah brings up an amazing point. While this guy talks crap, he's talking crap. Debt ceiling expiry is 31st of July. That truly. I actually was looking for that recently. I'm going to put that one down. Absolutely, dude. Debt ceiling. What a great catalyst. I like it. I like this idea. Buy the rumor, sell the fact into it, and then debt ceiling. Last year, during a global pandemic and deep recession, CEOs paid themselves 299 times what their average worker made. Oh my God,
an even bigger gap than before the pandemic.
Shut up.
Now imagine the kind of windfall they'll try to rake in during this boom. We've seen it over and over. Consumers spend, driving up revenue for companies.
He's anti-capitalism.
They spend it on stock buybacks while complaining about workers demanding higher wages. Big banks rake in cash. They spend it on executive compensation and dividends and buybacks, and the Fed has usually allowed them to, Mr. Chairman. Instead of lending in communities or increasing capital to reduce risk. The Fed should be fighting this trend, protecting our progress from Wall Street greed and recklessness, not making it worse. During your tenure, Chair Powell, the Fed has rolled back important safeguards, making it easier for the big banks to pump up the price of their stock and boost their already enormous power in our economy. Wall Street would have you believe
My God.
that removing those protections has increased lending and supported the real economy. We've been assured that the banks have plenty of capital to withstand a crisis. But during the pandemic, it was community banks and credit unions, not the mega banks, that increased lending. The Fed supported the biggest banks to the tune of hundreds of billions of dollars. They spent it shockingly, on themselves, while small businesses trying to get PPP loans couldn't sometimes get their phone calls returned. We ought to try something different. We need a banking system that works for everyone. We can't allow the biggest banks to funnel their extra cash into stock buybacks that juice their profits instead of investing in the real economy. We can't let big banks merge into bigger and bigger mega banks, making it harder for small banks to compete and leaving rural and black and brown communities behind. We need to strengthen the Community Reinvestment Act so that banks serve the communities still scarred by the legacy of black codes and Jim Crow and redlining. And we can't allow a repeat performance of the years during the last recession. Wall Street destroyed our economy, cost families their jobs and their homes and their savings, then came roaring back. Families limped along behind them. For the vast majority of Americans who get their money from a paycheck and not a brokerage account, the economy never looked all that great in the years that followed. Stable prices, moderate long-term interest rates aren't enough if every decade a financial crisis hits and strips away what people have worked so hard for. Low unemployment isn't enough if the jobs pay rock-bottom wages and workers have no power. GDP growth isn't enough if it only benefits those at the top and not the workers who made it possible. We need to create a different system, one that's stable for the long run, one where workers, not Wall Street, reap the benefits of a strong economy. Mr. Chair Powell, you're charged with ensuring both financial stability and with overseeing the biggest banks. Both those jobs are equally important. Each affects workers' jobs and paychecks in communities, and as public servants, our responsibility, yours, mine, Ranking Member Toomey, our responsibility is to the people who make this country
Anyone
work.
else more scared of this guy?
It's up to us to grow an economy
I'm more
that
scared of
delivers
this
for
guy
them,
about
not
the
just
market than
those at
Jay
the top.
Powell himself.
Ranking Member Toomey.
Thank you, Mr. Chairman. Welcome back, Chairman Powell. The economy certainly has come roaring back from COVID. GDP is above its pre-pandemic levels now, and the Fed forecasts GDP will grow by an amazing 7% this year. The unemployment rate is already at 5.9%, which the Fed expects to fall to 4.5% by the end of the year.
Phil C says it's
and to put that in context, the average unemployment rate for the last 20 years before the pandemic was 6%. So with these conditions, the Fed's rationale for continuing negative real interest rates and $1.4 trillion in annual bond purchases is puzzling. The Fed's policy is especially troubling because the warning siren for problematic inflation is getting louder. Inflation is here, and it's more severe than most, including the Fed itself, expected. And it is more than offsetting the wage gains, so leaving workers worse off despite their nominal wage increases. For the third month in a row, the Consumer Price Index was higher than expectations. Core CPI, which excludes volatile categories like food and energy, was up 4.5% in June, the highest reading in almost 30 years. And to be clear, this is beyond the so-called base effects. The 2-year change in core CPI was at a 25-year high. And with housing prices absolutely soaring in many places to completely unaffordable levels, I have to ask, why on earth is the Fed still buying $40 billion in mortgage-backed bonds each month? Now, the Fed assures us that this inflation is transitory, but its inflation projections over the last year have not inspired confidence. Last June, the Fed projected that PCE, one standard measure of inflation, would be 1.6% for the 12 months ending 2021. Then in December, the Fed raised that figure up to 1.8%. And now the Fed's most recent PCE forecast for 2021 year-end is 3.4%, more than double what the Fed thought inflation would be a year ago. But in coming months, the Fed is almost certain to revise that projection up yet again, because so far this year, PCE has already risen by 6.1% on an annualized basis. So for the rest of the year, inflation would need to be nearly zero for the Fed's latest projection to be proven correct. I'm very concerned that the Fed's current paradigm almost guarantees that it will be behind the curve if inflation does become problematic and persistent for several reasons. First, as I pointed out, the Fed has consistently and systematically underestimated inflation over the last year. Second, the Fed has announced that it will allow inflation to run above its 2% target level.
Let me check.
Well, it's already well above 2%. And third, the Fed insists that the inflation we're experiencing now is transitory, despite the fact that recent unprecedented monetary accommodation has certainly driven the inflation that we're witnessing. And since the Fed has proven unable to forecast the level of inflation, Why should we be confident that the Fed can forecast the duration of inflation? And after all, you can only know that something is in fact transitory after it's ended. What if it doesn't end? If it's wrong, by the time the Fed knows and acknowledges that it's gotten it wrong, we could have a big problem on our hands. And past experience has shown it's very difficult to get the inflation genie back in the bottle once it's out. The Fed may have to respond by raising interest rates much more aggressively to rein in significant inflation, and that could have severe adverse economic consequences. So the Fed's current monetary approach seems based on the premise that
I'm going to bring him down here for a second because he's saying nothing much. All right, so what just happened? A bunch of people attacked the banks and attacked everything else about the Fed. Obviously, I don't think that's really that big a deal. They've probably heard these people rabbit on before. But effectively speaking, yes, we have a bit of selling here going on in the morning. Quite a large switch. Still, the Chinese stocks were the best of the morning. Baidu, Tesla also coming through, Alibaba. I'll just leave him in the background until we get the J Powell. So we're at 0.57 down the US 100. It's a fairly big switch, obviously led by things like the FANG stocks coming down. We've got CRISPR, the Biogen stocks are still down as well. I mean, ARKG, wow, that's getting cheap. It's almost cheap. What else is going on here? All the main mega hyper kind of stocks that were on the support still seem to be holding in phase flat.
In our economy and some of the responsibilities that attend to that. The ability to direct interest rates and control the money supply is
the Chinese tech stocks are the best.
And Congress
AMC up 5. I'm not convinced that's a great rally though. Be careful there.
Interference. But Congress also gave the Fed.
When is J Powell coming? Is he coming soon?
Troubled by the Fed, especially some of the regional banks.
Tom, do you think inflation is transitory? Yes. Yes, Durgesh, I do. I think the thing is that you got to expect when you put it in that you're going to get this initial inflation. Also, I think there's more chance of deflation. I know a lot of people probably don't believe that, but yeah, that's the kind of way I see it. I mean, deflation is something that happened in Japan. Or stagflation at least, something like that. And it's often been had with quantitative easing. So I always look at Japan. Whatever's happening in Japan, I kind of just think of it that way. I imagine eventually the Fed will own 60% of the bond market, like they do in Japan, 60 to 70%. And for some reason, the wheel can keep turning. The real issue is, will we hit some kind of black swan event? And I don't even think I can mention the word here, but I would say the black swan event most likely to occur over the next decade is this sign here. Unfortunately, that's the one. Now, that is what I think is the main risk of the markets over the next decade. Well, to 2026, 2027.
We're strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. We pursue these goals based solely on data and objective analysis, and we're committed to doing so in a clear and transparent manner. Today, I'll review the current economic situation before turning to monetary policy. Over the first half of 2021, ongoing vaccinations have led to a reopening of the economy and strong economic growth, supported by accommodative monetary and fiscal policy.
Buying stocks, look.
Real GDP this year appears to be on track to post its fastest rate of increase in decades. Household spending is rising at an especially rapid pace, boosted by strong fiscal support, accommodative financial conditions, and the reopening of the economy. Housing demand remains very strong, and overall business investment is increasing at a solid pace. As described in the Monetary Policy Report, supply constraints have been restraining activity in some industries, most notably in the motor vehicle industry, where the worldwide shortage of semiconductors has sharply curtailed production so far this year. Conditions in the labor market have continued to improve, but there is still a long way to go. Labor demand appears to be very strong. Job openings are at a record high, hiring is robust, and many workers are leaving their current jobs to search for better ones. Indeed, employers added 1.7 million workers from April through June. However, the unemployment rate remains elevated in June at 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Job gains should be strong in coming months as public health conditions continue to improve and as some of the other pandemic-related factors currently weighing them down diminish. As discussed in the Monetary Policy Report, the pandemic-induced declines in employment last year were the largest for workers with lower wages and for African Americans and Hispanics. Despite substantial improvements for all racial and ethnic groups, the hardest hit groups still have the most ground left to regain. Inflation has increased notably and will likely remain elevated in coming months before moderating. Inflation is being temporarily boosted by base effects as the sharp pandemic-related price declines from last spring drop out of the 12-month calculation. In addition, strong demand in sectors where production bottlenecks or other supply constraints have limited production has led to especially rapid price increases for some goods and services, which should partially reverse as the effects of the bottlenecks unwind. Prices for services that were hard hit by the pandemic have also jumped in recent months as demand for these services has surged with the reopening of the economy. To avoid sustained periods of unusually low or high inflation, the FOMC monetary policy framework seeks longer-term inflation expectations that are well anchored at 2%, the committee's longer-run inflation objective. Measures of longer-term inflation expectations have moved up from their pandemic lows and are in a range that is broadly consistent with the FOMC's longer-run inflation goal. Two boxes in the July Monetary Policy Report discuss recent developments in inflation and inflation expectations. Sustainably achieving maximum employment and price stability depends on a stable financial system, and we continue to monitor vulnerabilities here. While asset valuations have generally risen with improving fundamentals as well as increased investor risk appetite, household balance sheets are on average quite strong. Business leverage has been declining from high levels, and the institutions at the core of the financial system remain resilient.
Was that a lie, pal?
Turning now to monetary policy. At our June meeting, the FOMC kept the federal funds rate near zero and maintained the pace of our asset purchases. These measures, along with our strong guidance on interest rates and our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. We continue to expect that it will be appropriate to maintain the current target range for the Fed funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2% and is on track to moderately exceed 2% for some time. As the committee reiterated in our June policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. As always, in assessing the appropriate stance of monetary policy, we will continue to monitor the implications of incoming information for the economic outlook and would be prepared to adjust the stance of monetary policy as appropriate if we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal. In addition, we're continuing to increase our holdings of Treasury securities and agency MBS securities, at least at their current pace, until substantial further progress has been made toward our maximum employment and price stability goals. These purchases have materially eased financial conditions and are providing substantial support to the economy. At our June meeting, the committee discussed the economy's progress toward our goals since we adopted our asset purchase guidance last December. While reaching the standard of substantial further progress is still a ways off, participants expect that progress will continue. We will continue these discussions at coming meetings. As we've said, we will provide advance notice before announcing any decision to make changes to our purchases. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. The resumption of our Fed Listens initiative will further strengthen our ongoing efforts to learn from a broad range of groups about how they are recovering from the economic hardships brought on by the pandemic. We at the Fed will do everything we can to support the recovery and foster progress toward our goals of maximum employment and stable prices. Thank you. I will look forward to our discussion.
Thank you, Chair Powell, for your testimony. Our economy looks a whole lot better today than it did last year. We still have a long way to go, yet Many of my Republican colleagues have been stoking inflation fears, demanding that we pump the brakes on our economic recovery, complaining that we're just investing too much money in the American people. If my colleagues are suddenly concerned about the costs that have been rising for workers and families for decades, they can join Democrats in the fight to raise wages, to lower the cost of health care, to make housing more affordable, to pass the American Jobs Plan. Of course, most of them won't say aloud what all this inflation alarmism is really all about. It's simply they don't want workers to have more power. In reality, the biggest risk to our economy, Mr. Chairman, is not doing enough to empower workers and not doing enough to curb Wall Street greed and excess. Chair Powell, my question is, you've supported Vice Chair Quarles as the Vice Chair of Supervision, his efforts to weaken capital requirements at the largest banks through revisions to the stress capital buffer, and you oversaw weakened CCAR stress tests, which ultimately decide how leveraged the biggest banks are. Governor Brainerd has pushed back against your efforts to weaken financial regulations. President Rosengren of the Boston Fed made the case that strong financial regulation enables the Fed to be more aggressive in its full employment mandate. President Mester of the Cleveland Fed, President Kashkari of the Minneapolis Fed are outspoken on the need for the board to keep its eye on financial stability. Weakening financial safeguards doesn't help working families. It just increases the risk of a financial crisis, wiping out everything they've worked so hard for. We're finally making progress, as I said earlier, and workers are getting a better seat at the table. We can make the economy safer and fairer with higher capital requirements of the biggest banks. My question, Mr. Chair, is why have you been against stronger capital requirements and using the countercyclical capital buffer in curbing runaway executive bonuses and stock buybacks?
So I guess I would say with the stress tests, the severity of the stress tests has very much been maintained. The effect of the stress capital buffer overall was to raise capital requirements for the largest firms, and they did manage to get through the recent pandemic and the acute phase of it and the recovery, and did their jobs during the so I think that by and large our financial institutions are well capitalized. We limited their distributions during the pandemic, and their capital levels actually rose quite materially during the course of the pandemic. So the financial system is strong and the banks are strong. I have felt, and I've said on a number of occasions, that the level of loss-absorbing capital in the system is about right. I think the experience of the pandemic bears that out. I would be prepared to deploy the countercyclical capital buffer if I thought that the conditions we laid out were triggered, but I haven't so far felt that way.
Every time the Fed is, thank you for that answer, every time the Fed's taken action to lower capital standards, it claims that doing so would increase lending in the economy and otherwise promote economic growth. That hasn't been what's happened. Instead, buybacks, dividends, executive compensation have continued to go up even during the pandemic. We empower workers by maintaining tight labor markets and strong financial regulations. I believe strong financial regulation enables the Fed to be more aggressive in helping workers, and that should be your mission. It's time, Mr. Chair, respectfully, you change the way you think about regulating the biggest banks. One other question, Mr. Chair. In addition to adopting pro-worker financial stability policies, the Fed can further help communities of color by leading the push for a strong update to the Community Reinvestment Act. We've seen some good developments there with a different controller of the currency. Last year, the Fed unanimously released a framework for modernizing CRA that was well received by representatives of the civil rights community and by banks. My question, Mr. Chair, is the Federal Reserve still committed to full, not piecemeal, full CRA modernization with an interagency approach, and what is the timing?
We're very much committed to that outcome, and I actually feel good about where we are on this. We're resuming our interagency discussions on it, and I'm optimistic that we'll come out with something that has broad support among the community of intended beneficiaries, and by the way, also among the financial institutions, and that it will be a good, solid updating after many years into the more technologically enabled era that will help the intended beneficiaries quite a bit.
And the timing, Mr. Chair?
Working on it now. I think you'll see you'll see we're reacting to a very large, analyzing and reacting to a very large quantity of comments and discussing that with, particularly with the OCC, but also the FDIC. It's not clear what their role will be at this time, but we hope they'll join in. I think we'll be making visible progress in coming months. I can't give you a finish date yet, but I think we're moving now.
Okay, thank you. We will be watching. Senator Toomey.
Thank you, Mr. Chairman. Chairman Powell, in your testimony, you said that substantial further progress is still a ways off for the economic recovery, and I think you cite that as a justification for the extremely accommodative policy that you have. I don't think you're referring to the need for substantial further progress in GDP growth. I think it's employment that you're thinking of. The unemployment rate has declined dramatically, but it hasn't reached the pre-pandemic lows. And I think you've also made references to the workforce participation rate. I guess my question is, isn't it entirely possible that for a variety of factors, not the least of which is legislation that we've passed, the labor force participation rate may not get back to the record highs that we recently saw, and we've made it more difficult for the unemployment rate to get back to the record lows that we were at before.
Thank you very much.
And do you take that into account when you determine how much progress we've made towards full employment?
So what was happening toward the end of the very longest expansion, was that people were staying in the labor force later into their careers, and so labor force participation consistently remained above all estimates of where it was going to be. Then what happened in the pandemic was a lot of those people retired. So there have been really significant amounts of retirement. So the truth is, we don't know where that's going to settle out, and it'll take a period of years for us to really understand what the new trend is. I don't see that as a problem for the standard we've set forth for tapering asset purchases, which is substantial further progress. We're not going to need to know the answers to those questions to make a decision that we've made substantial further progress. It will be more of a consideration for raising rates where we've set a higher bar.
Okay, I just hope there's a focus on the distinct possibility that we're just not going to get to those levels anytime soon. Let me turn to housing prices a bit. The Case-Shiller Home Price Index showed housing prices across the U.S. as a whole increased in May by more than 15% from the previous year, and that wasn't a base effect. There was no big decline in May of last year. 15% clearly is making housing
still cheap in America,
less affordable, more out of reach for more people. So a number of voices within the Fed seem to be increasingly concerned about this. The St. Louis Fed President James Bullard said just this week that he is, quote, a little bit concerned that we're feeding into an incipient housing bubble, end quote. Dallas Fed President Robert Kaplan said that the Fed should begin tapering to begin offsetting, quote, some of these excesses and imbalances, end quote. The Boston Fed President Eric Rosengren raised alarms that the Fed's mortgage-backed security purchases may be contributing to the current boom in real estate prices, citing the potential financial stability implications. I guess, I've been clear for a long time. I've been very skeptical about the ongoing mortgage-backed purchases. Are you at all concerned about the unintended consequences that are associated with $40 billion worth of mortgage-backed security purchases that continue month after month?
So housing prices are going up, as you mentioned, around 15%. This is a very high rate of increase. A number of factors are contributing. Monetary policy is certainly one of those factors. There are also other factors. People have very strong balance sheets, so they're able to make down payments. There are also supply factors that are constraining the supply, at least temporarily. So, my best thinking is that the difference between Treasury purchases and MBS purchases for this purpose is not a large one. Probably MBS purchases are somewhat more supportive of housing. That's not their intent, but that may be the effect. Really, the larger point is that monetary policy is supporting this, and that is that's a discussion we're going to be having on an ongoing basis. We talked about some of these things at our last meeting, and we'll talk at the next meeting in a couple of weeks.
I think that's important. Let me close with a question on a central bank digital currency. During your testimony yesterday, I sensed what I wasn't sure but thought might be a change in your tone about the virtues of a central bank digital currency being issued by the Fed. one of the things you said yesterday is that one of the stronger arguments in favor of a CBDC is that, quote, you wouldn't need stable coins, you wouldn't need cryptocurrencies if you had a digital U.S. currency. Of course, isn't the reverse also true? If you have stable coins, cryptocurrencies in use, then maybe there's no need for a central bank digital currency. I guess my 2 points. One is it's my view that the development of a central bank digital currency by the Fed would require congressional authorization. I'm wondering if you share that view. And secondly, it is still not clear to me what problem a central bank digital currency would solve, and I wonder if you think there are problems that only a central bank digital currency can solve.
So first, I'm legitimately undecided on whether the benefits outweigh the costs or vice versa or on a CBDC. Yesterday, I was answering a direct question about a particular argument. I said, in favor, that would be one of the stronger arguments. Okay. I would agree that the more direct route would be to appropriately regulate stablecoins, which we don't do right now, and that's going to be a very important thing that we do. So in terms of congressional authorization, there are different views on that. I've said publicly, and I think this is right, that we would want very broad support in society and in Congress, and ideally that would take the form of authorizing legislation as opposed to a very careful reading of ambiguous law to support this. It's a very, very important initiative, and I do think we should ideally get authorization. In terms of what the problem is to solve, I think that is exactly the right question, and I think our obligation is to explore both the technology and the policy issues over the next couple of years. That's what we're going to do so that we're in a position to make an informed recommendation. But my mind is open on this, and I honestly don't have a preconceived answer to these questions.
Thank you, Mr. Chairman.
Senator Menendez of New Jersey is recognized.
Chairman Powell, as the Federal Reserve seeks to fulfill its mandate of maximum employment, I want to discuss with you the tremendous impact that immigration has on the labor force. Isn't it true that over the past 10 years, the immigrant labor force participation rate has been consistently higher than that of native-born workers?
I believe that's right.
Yeah, and let me help you verify that. The St. Louis Fed noted in their study that as of June 2021, the foreign-born labor force participation rate is 3% higher than the native-born rate, and that gap hasn't ever been lower than nearly 2% for the past 10 years. And an important but often overlooked characteristic of these immigrants is their youth. According to the Bureau of Labor Statistics, 71.8% of foreign-born workers are between 25 and 54 years of age, compared to 62.2% of the native labor force. So as the American labor force ages, will immigrants, and therefore immigration policy, play an increasingly important role in maintaining a healthy U.S. labor force, therefore a healthy economy?
So, Senator, I'm going to stay away from making any recommendations on immigration policy. It's not in our wheelhouse. I will say that labor force growth is one of the two things that can drive the top line, the other being productivity growth. And, in recent years, immigration has been a significant part of, accounted for a significant part of growth in the workforce.
Well, I appreciate that. I'm not asking you about immigration policy. What I am saying is that one of the newest studies shows that nearly 1 in 4 Americans is projected to be 65 years of age or older by 2060. So while America gets older, the overall population is growing at a slower rate than it has in almost a century, leaving unfilled job openings in a future American economy. And I think we should be looking at our immigration policy, whatever that might ultimately be. I have my own idea, the U.S. Citizenship Act, as a source of dealing with the labor market. Now, let me continue on the question of the labor market. One part of the Fed's dual mandate is to maximize employment and understanding what factors inhibited people's ability to work as a key to helping achieve that goal. On page 7 of your monetary policy report, and I'll quote directly from it, the effect of the pandemic on employment was largest for workers with lower wages, for workers with lower educational attainment, and for African Americans and Hispanics. And these hard-hit groups still have the most ground left to regain. and the pandemic seems to have taken a particularly large toll on the labor force participation of mothers, especially Hispanic mothers.
You guys like this one, by the way?
That's very much true. So have disruptions in childcare due to the pandemic had a negative effect on employment?
Yes, they have, and also schools being closed. Caretakers generally are having a hard time getting back into the labor force for that reason.
The Federal Reserve's data shows that the pandemic's effect on childcare caused 9% of all parents to be unable to work late last year, and an additional 14% of parents had to decrease their hours, and this effect was especially pronounced among Black, Hispanic, and low-income households. So is the effect on childcare on employment isolated only to the COVID pandemic?
Sorry,
is the effect of the availability of childcare that is affordable on employment isolated only to the COVID-19 pandemic?
I'm going to guess really that the answer to that would be no.
Yeah, and it is no. Studies have shown that working families pay for childcare ending up 35% of their income on average, 5 times more than what the Department of Health considers affordable. So it seems to me that increasing the availability of high-quality, affordable childcare, like what President Biden proposes in the American Families Plan, has a positive effect on employment, enables businesses to more easily find qualified workers, and ultimately helps address supply bottlenecks. The same Fed study I just cited notes that reducing or offsetting the cost of childcare has a particularly strong employment effect on Black, Hispanic, and low-income families. The pandemic showed all of the inequalities in our nation, highlighted in a way so dramatic.
I was just saying, why is this dude asking irrelevant questions to Powell? It's not a Powell question. It's irrelevant. He's wasting our time, guys. We should send him a check and say, combined 1,000+ people viewing this stream need 20 cents.
Have shown in the Fed's, St. Louis Fed statistics, more.
All right, while he continues talking, I hear him in the background. I'll just do these super chats that came in with some stocks. So we've got David Taylor. You've been very patient if you're there, David. $5. Hi, Tom. Thanks a lot for the content. No worries, man. Could you please look at BMY and LLY? Right,
Chairman Powell, once again, it's good to see you, sir. And I have most certainly appreciated the time that you spent trying to not only educate us, but also to work with us. I understand that
I'll save you ask
clearly
the question
you've made
first.
It your mission to adhere to the guidance for the Fed in which you work to maintaining
I'll listen to him. I'll tell you if you ask a question.
Inflation over a period
he's asking
of
a question
time,
about inflation.
as well as full unemployment or full employment. And when we talk about it, it's always a combination of which one you're more focused on and how you maintain that, while at the same time responding appropriately in a non-political way to the actions of Congress and the administration. I'm just curious, with regard to today's position, we're coming out of a pandemic. We've put a lot of fuel into the economy with direct payments and so forth, and people are trying to get back to work right now. And yet we've got inflation, which right now in this current state seems to be above a 2% rate. Can you talk a little bit about the measurement time period that you believe is appropriate for shooting for a 2% goal? And if there is a concern that you would express or that you follow up with when we talk about overinflating or perhaps putting fuel in, what concerns you would have and how you would respond to congressional activity?
So the inflation that we have today, what we said is that if inflation runs below 2% for an extended period, we want inflation to run moderately above 2% for some time.
Good man.
This is not moderately above 2% by any stretch. This is well above 2%, and we understand that. And it's also not tied to, the things that inflation is usually tied to, which is a tight labor market, a tight economy, that kind of thing. This is a shock going through the system associated with reopening of the economy, and it's driven inflation well above 2%. And, of course, we're not comfortable with that. In terms of the test that we articulated, we said we wanted inflation to average 2% over time. We didn't tie ourselves to a formula. What we really want is inflation expectations to be anchored at 2%. Because if they're not, there's not much reason to think that inflation will average 2%. So that's really how we're thinking about it. What's the challenge we're confronting is how to react to this inflation, which is larger than we had expected or than anybody had expected. And to the extent it is temporary, then it wouldn't be appropriate to react to it. But to the extent it gets longer and longer, we'll have to continue to reevaluate the risks that it would affect inflation expectations and will be of a longer duration. And that's what we're monitoring.
You've been very careful, and I've appreciated the fact that you have done your best to be apolitical in this regard. And yet, at the same time, we're going to have a debate about whether or not we need to add additional fuel to the economy in terms of additional payments to individuals. And as we make that discussion, recognizing that you're going to do your best to be apolitical and simply to respond based upon your goals of the long-term goal of 2% inflation and full employment, how do you see this right now with inflation right now being the focal point, and yet the possibilities of more dollars being put into this economy in this recovery stage? What concern would you express, if any? And I know that your job is not to give us advice, but rather to respond to. What are the tools available for you to try to maintain that long-term goal of 2% during a time in which Congress may very well be adding additional fuel to the fire, so to speak, for inflation?
So the way it works is we watch what Congress is talking about, and then ultimately, and there reaches a point at which our staff will say that looks like it's got a good chance of happening, and then we'll put something into the staff will put something into the forecast, and all of us will make our own judgment about whether that was the right thing to do, whether it's too big or too small. And we never then take that into the public sphere and say, please don't do that for this reason or that reason. It's really not up to us to play a role, as you know.
But the tool that you would use would be within monetary policy of the price of money.
Always, the tools we have are, in monetary policy is to raise interest rates, to tighten financial conditions more broadly, to slow demand down, and that's how you get control of inflation, and that's what you do. At a time like this, though, policy is so accommodative. It'll still be accommodative after we slow asset purchases, ultimately stop them, and then raise interest rates. It'll be accommodative for quite a while, but that's what we do, and that's what we will do when and as we need to. In the meantime, we're trying to understand this particular inflation is just unique in history. We don't have another example of the last time we reopened a $20 trillion economy with lots of fiscal and monetary support. We don't. So we're just trying to be. We're humble about what we understand, but we're trying to both understand the base case and also the risks.
Mr. Chairman, thank you very much for your response. And Mr. Chairman, thank you.
Senator Round. Senator Warner from Virginia is recognized.
Thank you, Mr. Chairman. And Chairman Powell, it's great to see you. Thank you for your good work.
Just out of interest.
One of the issues that you and I spent a lot of time talking about over the last year plus
massive
has been,
prints here coming in for the Vanguard Treasury funds yesterday.
And
at the close, this just comes out of our private group.
Communities of color, we lost 440,000 black-owned businesses last year.
Obviously, a bit of rotation going on.
And as we've discussed in the past, I've been a big advocate with many on this committee on both sides of the aisle to promote investment into minority depository institutions, into community development financial institutions, and actually working with former Secretary Mnuchin, we got $12 billion into the relief package back in December. Some of that will go into, as you know, Tier 1 capital into the CDFIs, which could actually increase their lending capacity by about 50%. But getting that access to capital to low and moderate income communities is really, really important.
Is the best decision.
Is there more that the Fed can do? Let me give you a two-part question. The Fed can do to support CDFIs, and is there anything similar to programs like the Fed's Paycheck PPP program liquidity facility, which could also potentially be used? I know, again, we've discussed some of these things, but I'd like to see if what your current thinking has been on this issue.
So we do see, and we saw particularly during the pandemic, the good that CDFIs and also minority depository institutions can do and we're doing. And we try to provide whatever resources we can, and a lot of it is just engagement and things like that, and also including the CDFIs in the PPP liquidity fund, and doing everything we could to incorporate them in a way that was useful to them. So all of those things are good. I think if we could think of more things to do within our mandate, given our authorities, we would do them, because we do see the good that they do in reaching communities that are not necessarily reached by other banks.
And I do hope, beyond CRA, that we can, look at. I've got a lot of community banks as well that want to try to get into this market, and got some ideas I'd like to come back to you and the Fed on, because I think sometimes there's a feeling that there's not enough regulatory discretion if they want to kind of lean into lending into low and moderate income communities. I wanted to raise one other issue. I think we all know housing prices are up dramatically. Matter of fact, the Federal Housing Finance Agency's House Price Index showed that house prices were up 13.9% over the 12 months ending in March 2021. I know a lot of discussion around inflation here. Obviously, if the housing market is overheated, that poses a huge issue. Is there, how overheated do you think the housing market is at this point? And what kind of tools do you have that could help deal with that problem?
Price increases are very strong in housing, and it's right across the country, and we see that, we hear that everywhere. And there, as I mentioned, there are a number of factors at work there, both demand and supply. There's a lot of demand because household balance sheets are just in the aggregate, in very strong shape. Monetary policy is clearly supportive of people who want to get mortgages now, although most of the people getting the mortgages have very high credit ratings. It's very different than it was before the global financial crisis. There are also, both their supply constraints.
I'm going to bring him down. It's the same question as before. All right, let's do these LLYs. Basically, it's the same stuff. He's just going to say the same thing. I don't know why they asked the same question twice. They're like talking a lot like me. All right, so LLY is on support, man, for your question here before. It is weakening from the looks of it. Let's have a look here at the daily. Daily 20 was bounced off before. Daily 20 maybe is another level you're looking at. But yeah, I would say overall it's weakening. It is on support, and it has to bounce right here. So yeah, sell off today down to this level makes perfect sense. Hopefully it turns around. Look for like a 5-minute lightning bolt the other way.
10-to-1 black versus white.
All right, AMC going crazy guns as well.
But I think it's also
makes some sense that it's going to have a rally. However, I still think even if it rallies into $40, it's going to have a big problem. Remember, it's testing from the top bottom up. So even if AMC rallies to 40 again, then it's still going to have issues. BMY, pretty nice. No breach of the 67, current price 67.90. So you're just looking for a breach up here. It's looking quite strong into this. Let's hope it does occur for you.
Thanks, Senator Warner. Senator Kennedy from Louisiana.
I'd be looking for like a weekly close above all these other closes, and that again should be quite bullish. Not bad. BMY looking for the breakout here.
Chairman,
next target,
by,
actually $70.
Thanking you once again, and
new guy. One sec. Let's see what the new guys say.
Some of whom are sitting behind you.
This guy is
well,
very nice.
remember well, spring of 2020.
He's gonna have a story.
When the world economy almost melted down. It didn't, in substantial part because of the actions that you and your colleagues took.
Taran, Canadian, $14. Let's give him a clap, guys. Thank you very much, Taran.
Some days you had to do it with spit and happy thought.
All right, that guy's just talking a lot of rubbish. Hey, Tom, holding on to CDIM for a while now and should have sold in June at 170. Got beat down after. Streaming company going global, up pre-market due to good ER today. Never holds on gains. What's your take? Well, unfortunately, I'm a little bit late to the party here, man. CDIM. Let's have a quick look here. Guess it is holding for you, which is good. My take is actually, I mean, from a weekly perspective, you had a really nice weekly bullish candle. You got lower, and then of course now it's moving on up here.
We have spent an enormous amount of money.
And
It's breathtaking.
Yeah, I mean, while it is dumping off, as you'll note, this resistance, I would hope, should be support. Now, look to the weekly close, because if the weekly close did close above like $1.40, I actually think you might even get your target again. That would be very, very bullish here. So yes, resistance becoming support. You need this thing to hold $1.28 today. I think you're probably correct with your analysis, but there's so much stuff that's good about this. If it holds up, look at this downward trend line. Multiple lower peaks, man. Suddenly we've got a bullish one that pushes it through. This is changing the game due to earnings, and then of course you've got effectively the resistance becoming support. So you've got break of the trend line if it holds, and if it holds here, very, very good. Good luck, sir. Oh, he's got a question.
Benefit of the extra deficit spending become less than the marginal cost?
And I don't think there's a precise point that I can identify. I will say that we're not on a sustainable path. We actually haven't been for a long time. That just meaning that the debt is growing substantially faster than the economy, and in the long run, that is not sustainable. We're going to need to, that the laws of gravity have not been repealed. We will need to get back on a sustainable path at some point. I think the time to do that is when the economy is strong, unemployment is low, taxes are rolling in. That's the time to do it, and to do it, with a longer-term plan that matches up our spending needs and our revenues. That's what we're going to need to do. We will eventually have to do that.
When do you think that will be?
I wish I knew. I mean, I would say the dollar is the world's reserve currency. People are buying our paper around the world. I don't think there's, any issue of being able to fund our deficits in the near term and the medium term. There's no evidence that there is, but we shouldn't wait until the urgent need arises.
Yeah, it's too late then. Well, I mean, everybody seems to be a Keynesian now, and that's fair. Dr. Keynes was brilliant, but some people forget about that chapter in one of his books where he said, "Okay, you deficit spend and you borrow to stimulate your economy."
All right, man. We know We know that they've ruined the economy. We understand. They have. We all know this.
You pay it back. The other thing that none of us wants inflation.
This guy doesn't want any
inflation.
inflation,
as you know.
He just said that none of us want any inflation. Damn it.
I worry that if we spend this extra $6 trillion or $5.5 trillion that President Biden wants to spend,
that might have to be it for me. I didn't expect him to go on for an hour here, having a little bit of a chat. But I don't think that guy really has that much to say. Look, we've seen the markets rally, then, of course, fall back again. Dow seems to have rotation into it here. Let's have a look at the sectors. I'll mute these guys off for a second here. Because his question is not relevant, I don't think. Okay, so let's have a look there. I want to bring up the sectors for today so you guys can see it. Always check your sectors on the day. Understand what's firing, what isn't firing. Try to put it together. Does help out. And I'll show you them right now. You can use Koifin if you're not familiar with it. Koifin is a good free service here to check it out. And you can add extra sectors that you may like. So straight away, you'll notice a few interesting things. So we've got utilities, number one. We've got consumer defensive, kind of the staple side over here. Flat as attack. We've got semiconductors, unfortunately, down today. And then, of course, we've got the other ones through across the board. So it looks like utilities, a move into that might be happening here at the moment. Decent breakout. Notice utilities, this brown one, starting to improve, starting to come through a little bit nicer than it has been. For the 3 months, utilities has been the worst performing sector. And it does usually only spike into like some kind of bearishness coming forward. So if we continue to see utilities move forward, and of course the market also bulls, and everything happens like we talked about, debt ceiling supposedly in the US coming in 31st of July. You got 27th of July as Apple's earnings, and a huge run into that earnings if that continues. All of these things are looking, I think, bearish. For now, though, things are still looking relatively bullish. We've got a nice looking Dow here today with a big rejection. We have, of course, US 100 definitely looking a bit dodgy, but that could come straight back into the... Actually, it did hit it before. It hit it while we were live streaming. I don't want it under there, guys. That will be bad. So we'll check that out in tomorrow's video. Watch that through that day. We need rallies all over here. All the rallies come in on this point. If they don't, and it doesn't hold above here, then we're starting to talk a totally different story for the QQQ. Notice the 4 hour here. So the real 4 hour 20 actually didn't hit 359 on the QQQ. So we'll check that out. If it does happen, I expect rallies to come in on this level. See the difference between the fake market futures and the real one? It's a big deal. All right, guys, I'll leave you. It's 12:30. Thank you so much for joining us for the 900 viewers. Appreciate everyone's donations. Appreciate your support. And hopefully CNBC don't dock me of those sweet Google ads. I need them to buy more Square stock. Okay? Nah, I'm done with you, Jack Dorsey. All right, catch everyone. Bye for now. Oh, they'll raise the ceiling. Don't worry about that. It'll all be good. But it might be a catalyst. Lieutenant Dan says, don't utilities fire at the end of the bull? Yeah, this isn't a fire you want to hold utilities. It's just a slight trade. Remember, there's a difference between trading into a defensive area and holding it for a short period of time, like a bond or something, and moving through to the other stuff. Like that, they'll just hold it for a small period of time. And then